Hello friends, this is Raj Sastry from Raj Option Trading. Today is June 3rd, 2022. Hope you're all doing well. In today's segment, we will take a look at Hewlett Packard Enterprises, ticker symbol HPE. This is a edge to cloud company, and they're good in cloud computing, and they're also into servers. So with that, let's jump in and look at HPE and see if it's worth buying. And stock tumbled after the quarterly earnings yesterday. Good time to take a look at this company and see if it's worth buying up here. All right, let's jump in here. We'll start with the quick background about the company, see what the company is doing, and then let's look at the competitive landscape and look at the top companies in this area like Cisco Systems, Dell, Pure Storage, NetApp, and so on and so forth. And then let's look at the fundamentals of HPE by looking at the numbers, both annual numbers and quarterly numbers. And then look at the technical analysis and see if it's worth buying based on technical as well as fundamentals. And finally, let's conclude with the rating. Is it buy, sell, or hold? So with that, let's jump in. Look, from a leadership perspective, we got here Mr. Antonio Neri, and looks like he's got very good approval ratings, 92% approval ratings from his own employees. And look, there is a huge number of ratings here, 3,200. So to come out at the top with so many ratings with a 92% approval rating, that's a very good achievement this CEO has. I think CEO checks out here. Mr. Antonio Neri, he's doing a great job. He's getting the support from his employees and approval from his employees. That's a good one. And HPE, they are making a big play into the cloud with their edge to cloud platform, called HPE GreenLake. It's a good platform. Will let customers buy for a monthly charge. I think it's a good one. So you don't need to buy these huge equipments outright. You can just lease it or rent it with the HPE GreenLake. And the CEO here, he's got a nice experience, more than 25 years in HP. Looks like he's a company veteran. He knows the inner workings of the company. So with that, CEO checks out. He wants to really lead the company in the right direction. All right, now let's jump in here and look at HPE in little more detail. And they had their quarterly earnings. Look, they are differentiating with their edge to cloud portfolio. Think about their HPE GreenLake portfolio, which lets you lease or rent the cloud computing platform for a monthly or a usage fee. And looks like they got a nice order growth here, 20% order growth, which is for the fourth consecutive time here. That's a good one here. They're doing pretty well from a demand perspective. No issue on the demand. And the net revenue also 6.7 billion, and a nice increase here. And they got some outlook issue with the supply chain challenges, but no issue on the demand side. And HPE GreenLake, it's one of their highlight here, their edge to cloud platform here. Looks like HPE GreenLake is firing in all cylinders with a nice growth here. Their orders is growing more than double year over year for the third straight quarter. Looks like they're doing very well here, and they also have convergence with Aruba. I think they acquired Aruba a while ago. Looks like that's also going pretty well here. And finally, from a margin perspective, they got some good margin, 34.2 here. And even in this challenging environment, they're able to maintain the margin. And it's a profitable company with a nice earnings per growth here, earnings per share. That's a good one. It's not a money-losing company. And at the high level, as you can see here, they got intelligent edge, they got compute, artificial intelligence, and storage. They got nice areas here where they can grow for years to come. So it looks like from a demand perspective, demand checks out. There is no issue around the customer and enterprise demand for HP's products here. All right, now let's jump in here and look at their cutting edge platform called HPE GreenLake. It's an edge to cloud platform. This platform has got analytics, artificial intelligence, machine learning, workload orchestration, and so on and so forth. If you're a mid-sized company or even a larger company, you don't want to buy all these equipments outright. You want to try out some concepts and do some proof of concept or experimentation. You go and subscribe to a HPE GreenLake platform here. You try out your experimentation, and if you like it, then you can keep renting it, or if you want, you can buy the equipment outright if that makes sense to you. I think it's a great idea, especially smaller companies. If they want to experiment some new technologies, they can really go into HPE GreenLake and rent or lease this platform for a monthly fee, which is a great idea. I think this is really cutting edge, and HPE seems to be doing pretty well in this area. All right, now let's look at the HPE Enterprise here. Look, HPE Enterprise, they provide customers to allow, capture, and act upon data. This is where their GreenLake platform comes in. And they basically provide servers for multi-workload computing and optimized servers. And they got your rack system, blade system. Think about all your computing needs. You need those big machines that can really crunch the data. That's where HPE comes in. And they also have the storage, networking, traditional tape, disk products, and so on and so forth. So think about HP as a server company. They also have a storage and memory, compute, so on and so forth. And look, stock has been dropping off here. Right now, stock price is at $14.96, almost $15. Look at this drop after the earnings. It's dropped by 82 cents or 0.520%. Look, stock has been dropping off, going in the sideways, mainly because there is a supply chain concern, as many of you know here. And for HPE to make those big bad servers, they need all this equipments and memory, compute, so on and so forth. So because there's a supply challenge here and logistic challenge, they had to cut down their outlook slightly. That's why stock came down. Analysts are expecting a nice moderate buy here. That's a good one here. 5 of them say buy, 4 say hold. That's why it's a moderate buy. I think it's a great idea to buy this company. It's a great company. They're doing pretty well here. And also look here, they seem to have a nice support level right here around $14. So I would be buying up here. You can expect a nice bounce back. Situation can only improve. China is slowly opening up here, and some of these supply side challenges should go away slowly. But look, company gave this outlook here, and the stock dives. They miss outlook miss. So that's why stock came down here. Situation should improve. I would take advantage of this big huge drop here. And look, they got some treacherous market here, mainly with the supply chain issues, and they miss earnings and revenue. That's why stock came down, and they got issues supply chain, as you can see here. The news here is really company doing well, no issue on the demand side, strong demand for their product, but they're unable to meet the demand because of supply issues. That's a good problem to have. The situation is going to improve as you go forward. All right. Now let's jump in and look at the price target. Look, from a price target perspective, the stock price is at $14.96, almost $15. The lower target is 13.50, not too much downside from the current level. Upper target is 21 and mid target is 17. It's a pretty stable company, steady eddy, and they keep churning and generating revenue on a quarterly basis. And right now, look, technical perspective, it's a sell. Fundamental perspective, it's a neutral to buy. So that's when I jump in here, because look, right now it's sold off here. You have to buy the stock when it is sold off. Look at fundamentally good company. That's how you make money. You don't make money by chasing the stock that's going higher. So if you buy a stock like HPE when it's down, wait for a quarter or two, stock will go higher. That's where the big money is made. All right, now let's jump in here and look at the health scores. The reason I love this type of chart from Stock Rover, by the way, Stock Rover is one of my favorite screening and research platform. They provide very good actionable data. This is really for buy and hold type investors, and they have wealth of data, lot of metrics. That's one of the reasons I love this broker, and I might make a video on this broker so that way you know the features of Stock Rover. And look, right now fair value is around $16 and stock is trading around $14 or $15. That's why the stock price is below the fair value. I like it. And look, margin of safety is 13%, not too much. I like this number to be higher, but right now it's lower. Overall valuation is nice here because stock came down here. Valuation is down. That's when I like to buy. It's a growth company, not growing greatly, but more above average growth. That's good here. From a quality perspective, which is really margins, from a margin and the bottom line perspective, stock is doing very well. Look at that quality, 85. Compared to industry, that's a good one here. They were even better earlier, but I think it slightly came down off late, as you can see here, but still it's good with 85 here. And sentiment perspective, folks are still saying buy this company. Sentiment is high even though stock came down. And from a Piotrowski F score, this is one of my favorite score. It tells you how are the books improving. A score 7 tells you their books are doing pretty well, even though as you can see here slight drop off in the recent quarter, but books are doing great. Any score above 6 is good. 7, 8, 9, they are the great. 9 is the highest score in Piotrowski F for the top-notch companies. And then you got Altman Z score, the standard when it comes to financial stability. It's a less, I want this number to be more than 1.8. Right now it's 0.8, so it's a less here. Financial stability is a little bit not great, but knowing HPE, they've been around for a while. There is no issue. I think they can go past this and improve this Altman Z score going forward. But right now, trend is okay here. It's improving, as you can see here. But I like them to improve the score more. I think even the trend, I think it's both are red here, but at least there is some improvement. I want them to improve this Altman Z score going forward. As we compare this company with the peers, look, from a overall rating perspective, they're doing very well, doing much better than the peers. Growth-wise, middle of the road, as you can see here, 51. Valuation is very low here. It's a profitable company. That's a good one here. Low valuation means you're not paying too much. And from a bottom line margin perspective, they're doing great with the nice efficiency rating against the industry and peers. Financial strength is above average, not great. It's also indicated by Altman Z score here. I want that to go higher. And they pay some dividend, as you can see here, 94. That's good here. And momentum right now, it's pretty okay, not great, but it's above average. And from a target price perspective, average target price is $13. And look, current price is around $14. So right now, average target price is below the current stock price. But look, price target change here, it's 18%. Target price and percentage of change here. So I think overall, I think this stock can go higher from here. Given it's beaten down yesterday, I think they can go higher here. And look, from a forward PEG perspective, price to growth ratio perspective, as well as forward PE ratio perspective, it's pretty low here. It's a low valuation. And as you scan through here, from a EPS current year change, it came down because of the supply challenges, and they cut down slightly. But 5-year growth estimate, it's nice here. It's positive. That's a good one here. Next year, sales growth is also positive. That's good here. This is not that company that grows by, say, 20% or so. It's a steady Eddie type company. It's in the server business. And earnings per share surprise is negative after the drop off here, after the earnings. earnings. And the rating perspective, it's a buy. It's still a buy at these levels here. That's one of the reasons I like this type of chart. It not only tells you how the company is doing, it tells you how the company is doing against or compared to the peers. That's one of the reasons I like this chart here. All right, now let's jump in here and look at the competitive landscape. Before we look at the competitive landscape, look, any company, we want to see a nice order growth. With HPE here, their order growth is pretty good here. Look at the growth here, Q1 22, Q2 22, so on and so forth. Nice annual run rate, or we call it ARR. So annual run rate, revenue run rate is very good here. I think we like it when there is a nice annual run rate here. And as you scan through here, look at the software here. They seem to be doing pretty well on the software side here. Look, the software is growing pretty nicely here. I like it. And look, from a as a service order growth here, it's been trending pretty well here. This is on a quarterly basis, and right now they're at 107% growth. That's a very good here. And they're also reaffirming the annual recurring revenue ARR by nice 35 to 45%. That's also great. Looks like companies are really having some order growth, no issue on the demand side, but supply side is where they have some concern with some supply chain issues and logistics issues of late. All right. Now let's look at the competitive landscape of this company. Look, top of the list here, this is sorted by market cap, as you can see here. Top of the list, we got the big dog in the space, Cisco Systems. Cisco also dropped off after the earnings last week. Even up here, Cisco is a good buy here. Stock price is at 44 and slowly going higher, as you can see here. I say, even at these levels, you could buy Cisco. You could see nice uptick here. This stock can go to $50 in a month or so. I think it's a good one to buy even up here. And we got few more here. We got Motorola. Motorola is also doing well. Look at that 5-year performance in these top companies here, including Pure Storage, and nice performance in past 5 years. And look, Motorola is doing pretty well here. I like Motorola. It's right now RSI is slightly high. I like to buy when the RSI is low. That way you get it at a good price and you can hang on for a little longer. When the RSI is high, that tells you stock is overbought. Generally, I tend to wait for RSI to cool off. Like Cisco here, I already bought this company when it dropped off to 41 last week. It's a great one. That's when I buy when the RSI is lower. And I look at the companies. Look, right now we have HPE here. Look at that RSI 45 and look at that overall score 94. That's a great one here. And look at that net margin. Companies making money. Companies like this HPE, which is making money and RSI is lower, that's when I buy slowly and accumulate after this huge bad news after the earnings. And then you got one more here, Juniper. Juniper is a stock that you can trade this. This has been stuck at around 2030 for a long time. But if you want to swing trade, you could swing trade Juniper when it misses on the earnings. But stock has been not doing well. I think this company may be bought by some other company, given it's just $10 billion market cap. And then you got a few more here. Keep a watch on RSI here. We got two more with the lower RSI, CIEN as well as Arista Network. Both are my favorite stocks here. You could buy these stocks at this level, given RSI a little bit lower here. And then you got a few more here, RSI a little bit higher. Look at the Extreme Network. Extreme Network has been doing great of late here. I would wait for a slight pullback and buy this. And Extreme is growing through the acquisitions very nicely of late here. All right, so we got here NetApp also. Look, NetApp is also good when it comes to storage, and this company has done well in the past. Right now RSI is 51, middle of the road. You could buy this one also. And I love this great company, Zebra. Zebra is a good one here. Stock is RSI is 50, middle of the road. You could even buy this great company at these levels here. All right, now let's jump in here and look at the industry ratings. Look, same stocks here. We got industry rating all the way from Altman Z score. 2 Morningstar ratings. So look, we got HPE right here, middle of the pack here. HPE seems to be doing pretty well here. They got a overall 7 rating in Piotrowski F score. Tells you books are solid. Financial and growth C grade, profitability B grade, overall score 94. I think it's a good one here. It's one of the highest score in this list here. And then you got Western Digital. It's also a good score here. Right now stock price is RSI is a little bit high. I would wait for a pullback here. This gets a 97 overall grade. That's a great one here. And I would focus on lower RSI candidates like Cisco Systems here. It's a good one to buy up here. Look at that nice rating from Morningstar, B grade when it comes to financials, B grade profitability, C grade growth. I would buy such companies when they're down here. And you could also keep scanning through here. Low RSI candidates. We got HPE. We talked about it. It's a good one to buy here. And we got, as you look through here, we got these two right here, CIEN and Arista Networks. Both are great here. Score-wise, they're doing well. You could buy both these companies here. And my favorite company here, ZBRA. You could buy this one also here. Nice score. And this company is nice and profitable, as you can see here. All right, now let's jump in and deep dive on HPE. From a snapshot perspective, look, HPE stock price is about $14.96, which is around $15. Nice market cap, $18.5 billion. Revenue per employee is around $461,000. Not great, but what do you expect from a server company, which is pretty okay here. Analysts recommend buy, no big deal. And price to sales ratio is very cheap here. Stock is not, its the valuation is not high. You could buy here, no need to worry. Stock has been dropping off here in past 3 months here. But if you look at the 2-year and 5-year, it's done pretty okay. Don't expect, Tesla-like stock movement here. It's a steady Eddie type stock here. And as you scan through here, this company also pays a nice dividend, 3.2% dividend. And dividend payout ratio is just 16.9. You are safe. They can keep on paying dividend with this payout ratio, which is very low, which is good. And as you scan through here, from a growth perspective, they got nice EPS growth for next year, 5.5, and they also have sales growth 2.9, which is good. It's a growing company, grows slowly, as you can see here. Nice free cash flow here, $2.2 billion, and nice cash on the balance sheet. No need to worry. And from a debt perspective, they got $14 billion, but interest rate, they locked in a low interest rate, 1.20. I think company is savvy that way. And as you scan through here, stock has been down from a technical perspective. From a moving average perspective, it's below its 200-day moving average. And look, price to call ratio is 1.068. That tells you folks are buying both call options and put options. It's a dead heat scenario. Options traders are not favoring either call side or put side. Whenever put call ratio is equal, you can be a contrarian and buy the stock outright given stock price is low here. And there's a nice indication these put holders can lose their money as stock goes higher. That's a good feeling to have. And as you scan through here from a grade perspective, it's a grade C from a growth and financial, but profitability is a nice grade B here. That's a good one here. All right, now let's jump in here and look at the numbers. HPE by numbers. Look, from a numbers perspective, company is making money. Look at that nice jump here in the earnings per share. It's a positive earnings company, and sales is pretty steady Eddie here, slight improvement as you can see here. And shares outstanding perspective, look, it's trending down. I like when the company is not diluting the share count here. It's slight increase, but no big deal. Overall trending down when it comes to shares outstanding. That's what we want to see. And from an operating margin perspective, trend is down, but off late it seems to be making some improvement here. I like them to improve the operating margin even further. Same story here, flat net margin, but nice jump here. I want them to continue the trajectory here with the net margin. Debt to equity perspective, trend is higher overall, but they improved the debt to equity in the recent year. That's good. I think they are paying down the debt, which is good. So overall, it's a steady Eddie type company, not rocketing revenue, but it's a steady Eddie company. Pretty steady when it comes to top line, bottom line. Also, they're managing. They're also paying some dividend. It's a value company. It's not a top growth stock. All right, now let's jump in here and look at the earnings history. From an earnings history perspective, look, they missed yesterday when they announced. They missed on the EPS or earnings per share. They missed on the revenue, and they also gave a little bit weaker guidance on the outlook because of supply chain constraints. That's why stock came down here. That's when I buy when the stock is beaten down. And they also had some challenges in previous 2 quarters or 3 quarters on the revenue side. So it looks like they have this issue for a while here on the revenue side, but now they missed on the earnings per share as well. That's why stock is coming down. So there is a lot of competition in this space. There are companies like Pure Storage tackling on the storage side. We got NetApp, we got Cisco, on the cloud and edge computing side. Companies also battling some of those competitions here. But overall, because it's beaten down and positive, profitable company, I would be willing to buy this company at this level here. All right, now let's jump in and look at the quarterly numbers. From a quarterly number perspective, look, this company was about $20 billion back in April last year. Right now, it's about $19 billion. It's around the same place here. It's hovering around 20, 21, 19. And look, stock price perspective, pretty steady Eddie. Don't expect huge up move here. It's a value stock, as you can see here. It came down during the COVID days to $8, but recovered nicely. Right now, it's about $14 or $15 here. From a sales perspective, it's a steady Eddie type sales here. Up and down slightly once in a while, but overall, it's doing okay here. And sales growth perspective, single digit sales growth, as you can see here. Past couple of quarters, which is okay. And earnings per share surprise perspective, they surprised on the negative side. That's why stock came down here. This is a quarter old here. Still, you can look at the trend by looking at this chart here. And gross margin is 33%. I think they're doing very well on the gross margin side. Positive net margin. And I think overall return on equity is positive and very low price to sales and valuation. So overall, from a quarterly number perspective, you see a steady Eddie company, not explosive growth. It's a value stock, as you can see here. All right, now let's jump in the seasonality. I love this seasonality chart from Stock Rover, mainly because it tells you when you can buy the stock. By looking at this chart, here, typically Jan, Feb, and March, this company outperforms S&P 500. It's well above S&P 500 performance. But look, April, May, and June, this will be lower. Seasonally, stock will be underperforming S&P 500. That's when I start buying. Now I know this stock is underperforming, in June the most. I would be buying in June and accumulating this HPE Inc. Then as we look at July, August, and September, it will typically go higher and one more buying opportunity. Then I would be offloading the stock around March timeframe next year. Every company has got a heartbeat. By looking at this chart here from Stock Rover, you can understand the heartbeat of the company, what's its rhythm, what's its pattern, and then buy accordingly. That's the way to make money. Just to understand, sometimes these trends might shift by a month or so. You'll understand it. It may not rhyme exactly, but it's always good to understand the pattern and what's the rhythm of the company and buy accordingly. All right, now let's jump in here and look at the technical. Look from a technical perspective, from a chart perspective. We got a 5-year chart. Stock is not there for 5 years, as you can see here. Started back in 2018 or so. Look, stock went higher. A nice downtick here, broke down here during the COVID days. Nice consolidation, went higher, Right now we are in a nice consolidation pattern. From these levels, I can slowly accumulate here. I can see stock going higher from here and go to 17, 18, or even to go higher around $18 here. That's why at these levels is a good one to buy. For the folks who want some dividend income, this also pays some good dividend. All right, now let's look at HPE on a 18-month chart or a year and a half chart. Look, from a 18-month chart perspective, stock is trending. It's doing pretty okay here. It's got its up and down. Right now stock is down, as you can see here, after the earnings. On the balance, volume is pretty okay here. Folks are still buying. That's a good sign here. Sometimes stock on the balance volume comes down after the nasty earnings, but this has gone higher or steady. That's good here. And look, the implied volatility came down, which is which happens after the earnings, which is good. And look, smart money is flowing into the company. That's why check-in money flow is going higher. That's also good here. And from a DMI perspective, the blue line is still on top. That tells you right now it's bullish, but blue line is coming down and red line is going higher. This can change, but right now you can expect a bearish crossover if the blue line goes below the red line. But I think situation might improve. This the blue line can start going higher in a day or two. All right, now let's jump in and look at the option chain. From an option chain perspective, we look at this. Even though you may not like options or you may not trade options, it's good to look at the option chain to understand what option traders are thinking. Look, stock prices at $14 or almost $15. All-time high or 52-week high is 17. There's a good uptick here by around $2 or $3 to go to 52-week high. And look, if you look at $14 or $15 right here, look, we got $15. And as you scan through here, the open interest is 121. But as you look through here, look, we got nice open interest here, 5,300 at $17. So folks are betting this stock will go to $17. That's why they're paying out of money call option by paying very low amount here, around 70 cents or around 55 to 70 cents. They're paying cheap money here and buying the call options out of the money. And there is also put option here. Look, there's a nice open interest here. Looks like there's a dead heat between call options and put options. Both are equal. All right, now as you look through here from a put call ratio perspective, put call ratio is one, almost one. That tells you number of call options traded and put options traded are almost equal. Put option is slightly higher. As a contrarian, when this happens, I typically end up buying the stock because if the stock goes higher, it can really cause these put option buyers to lose out. Typically, that happens. So I typically end up buying as a contrarian when the put call ratio is high and when the stock is already down. All right, now let's jump in here and look at the conclusion. From a conclusion perspective, HPE, they have generated significant order growth. That's a very good one. Steady revenue growth, sustained profitability, despite of the tight supply conditions. That's a good one here. And they got very strong demand. And look, they have a 20% year-over-year growth here. That's always good. And they also have a nice year-over-year order growth, which is around 20%. So overall, company doing pretty well here on the demand side, no issues. And they have they also have customer traction here, especially with their edge to cloud platform, which is HPE GreenLake. They're doing very well. Looks like their edge to cloud platform is gaining traction here. And because of the macroeconomic environment here, HPE had some issue and challenges, especially on the supply chain side of the house and logistics side. They got supply constraints. That's why they had a miss here. I think these supply constraints can be short-lived. Situation is improving. China is improving, as you know. Things can get better from here. And look, their HPE GreenLake, the cloud to edge platform, that's getting some nice traction here. It's got triple-digit growth. That's one of the reasons this company can do well and differentiate themselves with this as a service offering here. And right now, the momentum across the portfolio with the accessories model is differentiating HPE. Stock is oversold, and mainly because they got some short-term supply chain and logistics issues. I recommend buying the stock here. You can have a nice jump here in a quarter or two as the situation improves, especially on the supply side. So with that, thank you very much. Happy investing and trading. Please subscribe.